Let's start with a simple idea. You probably wouldn't want your roommate controlling your credit card. Sure, they'd promise not to spend too much. But then there's the midnight sushi, impulse shopping sprees, and surprise party planning. Now scale that scenario up to a country's entire economy, and what you get is why central banks need independence from governments. But let's break this down further. Central banks like the Federal Reserve in the US or the European Central Bank are the folks in charge of monetary policy, printing money, setting interest rates and keeping inflation in check. If they take orders directly from politicians, it's kind of like letting a teenager decide how much candy they're allowed to eat. Spoiler, it doesn't end well. So why do central banks need independence? How do governments go about creating this independence? And plot twist, is there such a thing as too much independence? Grab a coffee and let's dig in. Imagine a world where politicians controlled the central bank. It's election season, and what's a surefire way to get voters to love you? Spend, spend, spend. Lower those interest rates, print more money, and let everyone feel rich and happy, at least temporarily. It's like borrowing your future self's salary to party now and promising to deal with the hangover later. The problem is, in economics, that hangover comes with high inflation, skyrocketing debt, and potentially a financial meltdown. Central bank independence exists to prevent exactly that. These banks are staffed with economic nerds who care far more about long-term stability than short-term popularity. Their main goals usually revolve around: first, controlling inflation. Keeping prices stable is key. Nobody wants to wake up one morning and realise their savings can now only buy a loaf of bread. Looking at you, hyperinflation. Second, avoiding political pressure. Politicians focus on winning elections. They're human after all. But central banks exist to make the hard, unpopular calls, like raising interest rates when inflation gets out of control. Third, building credibility. If the public trust the central bank to act independently and wisely, they're less likely to panic. Investors are more confident, markets stay stable, and the economy ticks along like a reliable old clock. At the end of the day, central bank independence acts like that wise friend who tells you, hey, maybe you don't need another round of tequila tonight. Sure, you might grumble now, but you'll thank them in the morning. Here's where it gets interesting. How do governments create a system that keeps central banks independent, but still accountable? After all, we don't want these bankers turning into rogue economists with Bond villain ambitions, although a villain monologue about quantitative easing could be fun. First, legal frameworks. Most countries pass laws that clearly define the central bank's role and powers. This usually includes separating the bank's decision-making process from political influence. For example, central banks often have the sole authority to set interest rates without needing approval from politicians. The European Central Bank, ECB, is a textbook example. It operates independently under EU treaties, with its primary goal being to maintain price stability. Politicians can whine all they want, but they're legally blocked from interfering. 2. Fixed tenures for leaders. Central bank governors are often appointed for long, fixed terms. Think 4, 6, or even 8 years. The idea is that they can't be fired just for making unpopular decisions, like raising interest rates right before an election. In the US, the Federal Reserve Chair serves a 4-year term, which offers some protection against political meddling. 3. Clear objectives. To hold central banks accountable, governments often give them clear mandates. For example, control inflation to a target rate, usually around 2%. Promote maximum employment. Maintain financial stability. These objectives keep the central bank focused, while regular reporting ensures transparency. No sneaky money printing behind closed doors. 4. Limited direct financing. Many countries prohibit central banks from directly lending money to the government. That way, politicians can't just demand cash when they run out. It's like keeping your debit card out of your gambling uncle's hands. Why central banks shouldn't be too independent? Okay, so independence sounds great, but here's the twist. Too much independence can also be a problem. Think of it like a self-driving car. Sure, you don't want politicians constantly grabbing the wheel, but you still want someone around to ensure the car doesn't veer off the road. 1. Lack of accountability. If central banks are too independent, who's holding them accountable? These are powerful institutions making decisions that affect millions of people's lives. What if they get it wrong? Or worse, what if they're out of touch with economic realities on the ground? Critics argue that unelected officials shouldn't have unchecked power over monetary policy. In democratic systems, it feels a bit undemocratic. Second, coordination with fiscal policy. Monetary policy, central banks, and fiscal policy, government spending, often need to work together. For example, during economic crises, governments might increase spending while central banks lower interest rates. If the central bank is too stubbornly independent, it could refuse to cooperate, leaving the economy in an even worse position. It's like trying to push a car out of a ditch while your friend just sits there refusing to help because it's not their job. Teamwork matters. 3. Transparency and trust. Independence doesn't mean secrecy. Central banks need to communicate their decisions clearly so the public understands why interest rates are rising or why inflation targets are being adjusted. Otherwise, they risk losing credibility, and trust is everything in monetary policy. For instance, central banks like the Fed now hold regular press conferences to explain their moves. It's like saying, here's what we're doing, here's why, and no, we're not just randomly pressing buttons. Striking the balance. So where does that leave us? The sweet spot is a balance. Central banks need enough independence to resist short-term political pressures, but enough accountability to remain connected to the public they serve. Think of it like letting your roommate handle the budget, only if they provide monthly updates and don't treat themselves to designer socks. A good model combines legal independence to ensure politicians can't manipulate monetary policy for votes, clear mandates so central banks stay focused, transparency so everyone knows what's going on, coordination when needed, especially in crises. There are plenty of cases where a central bank is not independent and tanks the economy. Our next video will be on this very subject. For now, human history has shown that no independence is very much a problem. But too much independence? Do we have any cases where central banks do whatever they want and ruin the economy? Not clear. Usually the ruin comes from politicians being too grubby. If the central bank is independent and run by reasonable people, it tends to do its job as best it can, making mistakes, sure, but trying. Conclusion: a friend you can trust. At its core, central bank independence is about trust. It's about trusting someone to keep their cool while politicians are busy making promises and running campaigns. Without that independence, we risk policies that feel good in the moment, but blow up the economy later. But like all good friendships, independence has to come with boundaries and communication. Otherwise, we're just putting blind faith in unelected economists. And let's face it, even they can make mistakes. So here's the takeaway. Give central banks their space, let them do their thing, but don't forget to check in. After all, you wouldn't let your roommate have all the credit cards, would you?